Good morning, everybody. It's Monday, October 21st, 5:26 a.m. Central Time. December corn futures up 2.5 at 407 and a quarter. November soybeans up 8 cents at 978. December Chicago wheat up 3 1/4 at 576. December Kansas City wheat up 4 cents at 584 3/4. December spring wheat is up 2 at 618 and a half. Let's start off with export sales, which were pretty darn strong last week.
They sure were. Net corn sales reached their highest level in more than a year and a half and also surpassed pre report expectations at 88 million bushels. The print was up 82% from the previous week and up substantially from the prior 4 week average. Unknown destinations were the largest corn buyer for the week. Net soybean sales were reported at 63 million bushels. The print was up 35% versus the previous week and up 16% from the prior 4 week average. China was the largest soybean buyer for the week. Net wheat sales were near the upper end of expectations at 19 million bushels. The print was up 16% from the previous week and up 57% from the prior 4 week average. Mexico was the largest wheat buyer for the week.
These are pretty good export sales across the board. One thing that stuck out to me, unknown destinations were the largest corn buyer for the week. And if you look at weekly net export sales to unknown, that was the largest single week of export sales to unknown of the last 10 years. I think you got to go back to 2010 to find a week where unknown destinations bought more corn in a single week. So 903,000. That's very strong. Who is unknown? Why does USDA allow this to happen? Why do we allow export sales to unknown? USDA actually answered this question at their data users meeting April of last year. The question was this: you currently list your export sales to unknown. I cannot fathom why you still use it. Certainly there is a known party country on the other side of the trade. So why do we keep using unknown? This was USDA's answer to the question. This question has come up here in the past, and our regulations allow for exporters to report sales to unknown destinations to us when they don't know the destination of the shipment or where the product is going. And we understand that there are a number of circumstances within the trade where that might be the case. So as long as our regulations allow for that, then we have to continue to allow for it under the program. We believe that the most important thing is that we get information from the exporters about the sale and the quantity as quickly as possible, so the industry understands that the product has been committed. If we were to delay reporting until every detail is known, then that takes us information and data away from the market. The exporters do come back to us and change the destination to the country where they know it, when they know it. Ultimately, before the product is shipped, a destination has to be declared. We're trying to operate the program to provide the most transparency for the market. I think this is something we can continue to think about, but for the moment, I don't think we're going to make a change. So long story short is that USDA says we want to get the data out to the market as quickly as possible, even if all the details are not known. I don't know if I totally love that answer. I'd like to see some sort of destination attached to this, but we want them within 24 hours. We want to see the business. When it comes to unknown, who's buying this corn? You'd love it to be China. That would be very friendly to the market. Everything I've read and have been told about this would indicate to me that this is not China. If it was China, I think the market may be acting a little bit better, may act a little bit better. It would be reason to think that China would be in for additional cargoes. That's the way China does it. If they're going to do U.S. corn, I don't know if they're going to do it in a small way. But that's the explanation with regard to unknown. Soybean sales are still not quite where they need to be to hit USDA projections. We're now the fourth worst of the last 10 years instead of the third, but below average. USDA's got this year-over-year increase projected. We're going to need to see some better activity if we're going to hit that.
USDA reported more flash sales on Friday. U.S. exporters sold 21,000 metric tons of soybean oil to Mexico for delivery during the current marketing year. Exporters also sold 5 million bushels of corn and 11 million bushels of soybeans to unknown destinations for delivery during the current marketing year.
It's a decent soybean sale. Corn sales, smaller. Good to see the frequency, though. You're going to see a lot of that this time of year, especially in soybeans. It's this time of year and the couple months forthcoming here that we do the most soybean business. So you should continue to see some more of this, ideally.
The funds have increased their net short position in the corn market. CFTC released weekly commitment of traders data on Friday. As of Tuesday, October 15th, large money managers were net sellers of 73,000 contracts. This is the first time in 2 months that the funds have been net sellers of corn contracts. Funds were net sellers of 22,000 contracts of soybeans. Similar to the corn market, this is the first time since mid-August that have been net sellers of soybean contracts, and funds were net buyers of 1,000 contracts of SRW wheat on the week.
The buying spree is over. The funds are now, I guess, comfortably net short the markets. Not massive net shorts by any means. The positions in real time, according to the private groups, probably not too different than what we're seeing here. So you saw this big short covering event, and now it's ended. The funds went from being short 609,000 contracts across corn, soybeans, and SRW wheat back in July, and they didn't quite get back to even, but they got pretty damn close. And now they're short 178,000 contracts in net as of last Tuesday across those three contracts. I don't know if the short covering could resume, but for the moment, the big multi-week short covering event has very much ended.
So if you guys have not checked out our premium content, you sure need to do so. Joe, can you tell me about a premium video from last week?
Cost cutting for 2025. I know you're thinking about it or you're doing it. And this was an agronomy video that we did. This was not a marketing video. I'm not an agronomist. I don't know a damn thing about agronomy. But my friend Lewis Stearns is a professional agronomist, and he came on and talked about best practices for cutting costs in 2025 as it specifically relates to farming and agronomy. What are some of the things that you can cut? And then what are some of the things that are totally non-negotiable? I think this, I know all you guys are working with seed dealers and agronomists, but maybe to have like a non-biased third party view of this is something that would benefit you. I know that every penny counts in these tight margin environments, and this is was a really good watch. We had a ton of positive feedback on this one. If you guys want to see the premium stuff, go to standardgrain.com. You can sign up this morning. It's a $50 per month subscription. You can cancel at any time. No other fee, no other obligation. Nobody will try to sell you anything else. I know you guys are busy this time of year. It's a piece of cake. You can sign up on your phone. We do Apple Pay, Google Pay, credit card. It takes like 30 seconds. Everything we send out is very much accessible on your mobile device. All the videos are one click to play. The email is very easily read on a phone. There's no PDF to open. It's just really, really easy to do from a mobile device. So check that stuff out this morning, guys.
Rains are slated to accumulate in Brazil this week. There are some light rains on the radar in eastern soybean areas early this morning, although better coverage is forecast later this week. Both the Euro and GFS models indicate greater accumulation through this Saturday, with additional rainfall forecast in the long-term models. Many key soybean areas, with the exception of the country's far south, are likely to see above normal rainfall over the next 10 days.
Soybean planting should accelerate quickly. I think Agro was out early this morning and said they were 18% planted through last Thursday in soybeans, but you're going to see that number jump drastically here during the next week or two because of the returns of these rains. As far as rain as a percentage of normal, in a lot of your central soybean areas, it's going to be normal-ish. The far south will be drier than normal, but they've been very wet, so they could probably use some drier weather. So I see no immediate threat here. And yeah, beans are up this morning, but this is part of the reason that the bean market sold off here the last couple of weeks.
The International Monetary Fund is urging the world's economies to limit their fiscal spending. During its annual meetings in Washington, D.C. this week, the IMF will address the challenging future of slow economic growth and heavy debt. The organization is projecting that global public debt will reach $100 trillion by the end of the year. The U.S. and China are largely responsible for the rise in debt. The organization also expects worldwide public debt to equal the size of the global economy in the coming years if spending doesn't slow. The IMF is advising governments to reduce debt and rebuild financial buffers in order to be ready for the next economic crisis.
The world's $100 trillion fiscal time bomb. Pretty crazy stuff. So you've got some charts here of what the IMF is projecting with regard to debt to GDP ratios. And they're all going to skyrocket is the projection unless something changes, with the exception of Germany. They're projecting that by 2050, the U.S. debt to GDP ratio is going to be 200%, which is phenomenally high. Here's a statistic. Since 1821, 98% of countries that have hit 130% debt to GDP have defaulted on their sovereign debt. And then you go back and look at this. They're all going to be at 130%. If they're not there now, and the U.S. got really close recently, they're going to be there here in the next 10 or 20 years. You've seen a number of defaults, and they can happen in different ways. You can have restructuring, you can have devaluation, you can have high inflation. Some people might even argue, and I might be one of them, that the U.S. actually defaulted in 2008 when we bailed out the banks. And then we may have also defaulted again when we printed all the COVID money. So, default is a loose term that could mean a lot of different things. I believe that this chart indicates, and I think this is pretty close to reality, the U.S. money supply grew by $3.81 trillion in 2020. That's equal to 20% of all of the US dollars ever created. So maybe we're just in an inflationary default here. Maybe that's what it is. I don't know. We'll see what the history books say long after I'm gone.
The cost of interest on the U.S. national debt has climbed to its highest level in nearly 30 years. During its most recent fiscal year, which concluded on September 30th, the U.S. Treasury spent $882 billion on net interest payments. The payments are equal to $2.4 billion a day and represent 3.06% of GDP, the highest ratio since 1996. For the first time in history, the payments surpassed the Defense Department's spending on military programs. The substantial interest payments are primarily due to the sharp rise in interest rates, which of course were implemented to combat rising inflation. Interest costs have expanded to the point that they are now adding to the nation's debt and negatively affecting economic growth.
We have an election coming up in a couple weeks. And what's interesting is that, you watch like the debates and you watch the talking points. Does anybody talk about this?
Absolutely not.
Wouldn't you think that this would be a topic of interest to the American public? Like, hey, our interest on the national debt is higher than our defense budget.
I would
Like,
think
what are we going to do about that? It's like they talk about these, some of the matters are petty relative to this. I think this issue and the debt to GDP issue, these are defining issues of our generation. Yet neither political party seems to care a whole lot about them, and the press, the media certainly doesn't seem to care about it. It's not good. What did cattle do last week?
Cattle futures closed higher on Friday. Live cattle were 45 cents to $1.17 higher. However, for the week, live cattle were an average of 65 cents lower. Feeders were $1.60 to $2.37 higher on Friday. For the week, feeders lost an average of $1.50. Cash cattle trade was slow on light demand last week. Down in the Southern Plains, cattle traded at $1 higher at $1.88, and in the North, cattle were steady compared to the previous week, trading between $1.87 and $1.88. Box beef was higher on Friday. Choice ended the day at $320.65. That was up $1.39, and select was 68 cents higher at $294.20.
Outside markets, a little bit of movement. U.S. dollars higher this morning. Stocks are off. Bonds are off a little bit. Gold's up $14. Crude oil is up $1.42, back above $70, 70.11 in the December WTI. Guys, November grain and oilseed options expire Friday. Make sure you take a look at any remaining open positions there. Have a great day. We'll be back on Tuesday